Hey all, good morning and welcome to ShareTrek. This is Raj here. Welcome to the morning show. Yesterday we saw the market go up in the morning and then come down in the evening. As I mentioned earlier, we are in a bear channel. We'll talk about that again when we do the technical analysis of the indices. But suffice to say, any amount of analysis is not going to be of use at this point of time, at least for the near term of 3 to 4 days, because we are still not having any positive catalyst. Instead, I'm going to take the time to talk about the tax cut in the UK, which will be an interesting exercise because there are media reports which are supporting my point of view. I'll walk you through them, and that will be an interesting part of the morning show. With that said, let's get started. Welcome back, friends. Let me start off by setting the base argument and the base premises in place. We have monetary policy and we have fiscal policy. These are two policies that go on in any country which has got a democratic functioning government. The monetary policy is always with the central bank and it has got no political interference. For example, you have the Federal Reserve setting the interest rate, you have Central Bank of England setting the interest rate, or the Reserve Bank of India setting the interest rates. These are all independent entities, and their task is to control interest rate. And then you have exchange rate phenomenon. That's another thing that the central bank tries to monitor. Now, when you go into the fiscal policy area, that is in the hands of the politicians. And fiscal policy tools consist of things like tax cuts, incentives, subsidies, those kind of things. And both are used by the government as well as the central bank in order to monitor the economy and get it to where it has to be and provide a good standard of living for its people. So this is the way normal economy works. This is the way we have traditionally worked, and it works most of the time. And there are challenges like you have recessions, you have depressions, and you have various kind of situations, economic cycles. And these tools have helped us so far to manage and navigate through it and continue to maintain economic and social progress. Now, coming back to what's happening in UK, when Boris Johnson took over, we had the Brexit fever going on, and Boris Johnson promised to make sure that Britain got out of Europe and Brexit would be completed. And he became the Prime Minister. And of course, we have all seen what happened, and Boris Johnson had to leave. And there was competition between Rishi Sunak and Liz Truss. And Liz Truss at that time had said that she would prefer that the interest rate setting was not left in the independent hands. So we just have to keep this quote of hers at the back of our mind when we discuss what's happening today. Now, my thesis was that when you raise the interest rates, what the central bank is trying to do by raising interest rate is to incentivize people to put more money into savings. It's disincentivizing people from borrowing to take risk, thereby putting a curb on expenditures. And it's trying to mop out liquidity from the economy in order to bring down the inflation rates. And the central bank would increase the interest rates in small increments and calibrate it so that the excess demand is destroyed without taking the country into recession. So this is the delicate act of raising interest rate by central banks. There's another element that came into play during the COVID times when the government dished out a lot of money to sustain businesses and keep them alive when they were not doing business, and also to sustain employees who were sitting at home and small businesses which didn't have any business because the government had asked everybody to be under a lockdown. So all that excess liquidity that came into the market is called as quantitative easing. And the other activity that the central banks are doing right now is wherever quantitative easing had put a lot of money into the market, they are trying to do quantitative tightening to take it all back and restore a semblance of normalcy and bring inflation under control to the 2.5 to 3% range in which they are comfortable with it. Inflation is not bad. In fact, inflation is what helps the economy to grow, but inflation should not be 7 or 8%. Anything in the range of 2 to 3% is pretty good, and that's what most central banks aim for. Now, coming back to the situation in UK, while the central bank has been raising interest rates in order to curb the inflation and take the money out of the economy, we have this new Prime Minister and her cabinet coming in, and announcing not only tax cuts now, but also more tax cuts in the future. What a tax cut does is that it gives more money in the hands of people and corporations to go and spend. That is the opposite of taking money out of the economy. This is like pouring money into the economy. So you can imagine it's like somebody is taking water out of a bucket and another person is replacing the water in the bucket. So the net effect is going to be flat. As a result of which the global markets are looking at British pound and saying, you know what, we'd like to devalue it. So that's what is happening. And when that happens, it's more expensive for Britain to buy stuff from outside. So it's importing inflation. So it's got a compounding effect. So that's enough from my side of explanation. Let me show you some news articles that support what I'm talking about. Many of you may not like Larry Summers, but here we have Larry Summers blasting UK tax cut as utterly irresponsible and warns of a possible contagion. The sudden sell-off in the pound and UK bond market led economists to anticipate more aggressive interest rate hikes from the Bank of England. In a series of tweets Tuesday morning, Summers said that although he was very pessimistic about the potential fallout from the utterly irresponsible policy announcement, he did not expect the markets to capitulate so quickly. The likening of the UK to an emerging market economy has become more prevalent among market commentators in the recent days. So you have this problem which is now being recognized by international financial thought leaders. So that is one thing I wanted to show you about. We have another news article here which says UK lenders halt mortgage deals to customers after market chaos. It says the British bond and currency markets have been in a turmoil since Finance Minister Kwasi Kwarteng announced his mini budget on Friday. The yield on the UK 10-year gilt soared to levels not seen since 2008 on Monday, while the British pound plummeted to an all-time low against the dollar. Markets have begun pricing in a base rate hike of as high as 6% for the next year from the 2.25% currently, raising concerns among mortgage lenders and borrowers. Friends, what this means is that while the central bank is trying to reduce the inflation by increasing the interest rates, the fact that the mini budget has allowed for tax cut is going to put more money in the hands of corporates and individuals to spend, and therefore the international markets are looking at the Central Bank of England having to raise interest rate as much as 6% next year in order to get a handle on inflation. Now let us turn our attention to the US markets as well. In the US, for example, President Joe Biden has allowed for student loan forgiveness. It's a good approach, I'm sure, because students who have paid a lot of loans upfront are going to be at a very big disadvantage when they start their life, because first of all they have to pay off a whole lot of student loans before they can even think about buying a home. So it's in the right direction. But from an inflation perspective, it's going to put in a lot of money in the hands of exactly those people where it's going to be more impactful. This is the opposite of trickle-down economics. In trickle-down economics, you give a lot of money to the really rich people, assuming that they are going to use the money to take risks, create more jobs, and create more production capacity, and that's how we are going to spur the economy. Whereas the bottom-up approach is that give money to the people who are at the lowest end of the economy, because as soon as you give them the money, they are going to go out and buy food, clothing, shelter, the basic necessities. And therefore, that is going to spur a demand for those commodities, and manufacturers and businessmen will immediately respond to that by taking risk and putting their own money to create production capacity. So this is approaching the problem from the two different ends. So at this point of time, I'm not as much worried about the US as I'm worried about the UK, because the US dollar is very strong. It's making imports much cheaper, and it has a dampening effect on inflation. And also I'll show you another article in the US media which talks about similar to what Kathy Woods has been talking about, like we have a glut of inventory, and we have a very strong dollar which is making imports very cheap and putting a dampener on inflation. So let me show you the news article and then I'll come back to you. So here we have the news article which says Fed Evans says he's getting a little too nervous about going too far too fast with rate hikes. So speaking to CNBC Squawk Box on Tuesday, Evans said that he remains cautiously optimistic that the US economy can avoid a recession provided there are no external shocks. His comments come shortly after a slew of top Fed officials said they would continue to prioritize the fight against inflation, which is currently running near its highest level since the early 1980s. So this fear of getting closer to a recession happens when demand is destroyed thoroughly, and as a result of which the businesses find that they are not able to sustain their levels of employment, so they announce layouts and start shutting shop or reducing capacities, and that's when we head towards a recession. This is the most likely outcome when interest rate hikes keep continuing. The reason why central banks fear a recession when they're on the interest rate hike spree is because the economy is like a huge ship. It takes a little while for every interest rate hikes to show its results, and if you stop midway, then the inflation will continue to go further ahead. So the thin line between where you stop inflation and where recession starts is very, very difficult to predict, and therefore typically economies look forward to a soft landing where they stop the interest rate hike just around the time that recession happens. Right now, Chairman Powell is on record saying that soft landing is out of the question, and we are likely to get into a very brief recession. And that is the fear that Evans is expressing out here. And when Biden has given this student loan forgiveness and that money comes into the market, it's going to reduce the impact of a potential recession that might happen in the US, and gives a little bit of extra ammunition for the Fed to work towards a soft landing. That is my opinion. But when it comes to UK, the British pound is becoming weak. So they are going to import inflation, whereas US is importing deflation. So these are the two different scenarios in which we are looking at the economy. We are looking at the monetary policy and the fiscal policy. So in my opinion, Britain should not have done a tax cut. And the worst still, they should not have spoken about further tax cuts going forward. So with that, I think I'd like to end that segment here, and let's get into looking at the TradingView platform. Here we are in the Nasdaq futures out here, and each of these candles are a one-day candle, and you can see very, very clearly that we are inching towards this diagonal line of resistance. We may potentially come up a little briefly, but I think this tendency is pretty strong out here. The MACD is absolutely bearish, tending towards the signal line. Momentum just bounced off the 30%, as I expressed yesterday, that there's a possibility that we may touch 30 and come out again. We decided not to go down to the level that we saw on 26th of January 2022, which was 23.30. But if you see in the past, whenever we moved up, we have also come back down again. So the movement of going up and down in this chart kind of prevents us from thinking that there is no reason why we may not come back down again. We could potentially turn around, come back down again, and breach below the 30. Because right now, overall, there is nothing positive in the environment. Inflation is still going on, and the war is still going on between Russia and Ukraine. And we have political instability slowly creeping up everywhere. So let us start off with Italy. There we have a new far-right government, and Viktor Orban is aligning with Italy. And Russia is aligning with Orban. And you have Belarus. So European Union and its stability itself is coming under a lot of strain at this point of time. And out here in US, we have the midterm elections coming up, and also the January 6th inquiries and the DOJ action coming to a boil. So there is a lot of political uncertainty out here, and typically during midterms, until the midterm election happens, there is volatility. So I don't expect us to get out of this bear channel for a while now, at least for this week at the minimum. So I'm not going to do much about technical analysis. But if you look at indicators, and we go to US oil is up marginally, but it is still on a bearish track. I'm just going to put another line out here to show you a extended bear track that we have out here. We are still remaining within that. If you look at QQQ, again, we are in a huge bear channel, and we are continuing to barrel down. We have a support today at 273.52. Right now we are at 278.33, so that's our next support. S&P 500 is also down. Pre-market it's up 1.28%. QQQ is also up 1.45% pre-market. I'd consider these to be a dead cat bounce. IWM is up 1.58%. Again, a dead cat bounce because we are still in a bear channel, and we may go up and we may come back down again. We have a resistance here at 172.14. Right now we are at 166.77. Dow Jones is up 1.03%, and we have a support out here at 292.70, and right now we are at 295.74. so this is going to be the first level of support, and you can see that we are already below the 30% threshold on the RSI. And if we go back to the past, somewhere around 28th of February 2020, we were at 17.93. So there is still plenty of scope for us to fall down as far as the RSI is concerned. It's right now at 25.18. VIX has gone up and then come back down again, but it's within yesterday's range. So we have to see what happens with VIX. It went to the overbought stage and then got pushed down. So that's a good chance that it might turn back up again. And our MACD is also bullish. Now let us look at the US dollar index. US dollar index has hit this diagonal line of resistance and has come down again. But with more weakness in the British pound, there's a good chance that the US dollar index will cross over and go on top of this line of resistance that we have. The MACD is bullish and the momentum was overbought, which is the reason why it has come down. Once the momentum cools, the RSI cools, then it is going to go up again. Now let's go on and look at the index movers. When we look at index movers, I'm going to start with Microsoft first, which is up 1.28%, and we have Google, which is up 1.70%. We have Apple, which is up 1.56%. We have double bottom here for Apple. Let me see if we have a double bottom for Google. We don't have double bottom for Google. We don't have double bottom for Microsoft. So Apple has a rare double bottom out here. So Apple might probably recover. Friends, you should remember that Apple, Microsoft, Google, Amazon, these are the companies which are holding the index at a higher level, whereas other shares in the index have fallen big time. So index will fall very sharply when Apple, Google, Microsoft falls, and they have been falling steadily all the way since 17th of August 2022, and they are slightly consolidating a little bit on their way down, but I'm pretty sure that they are most likely to aim for 137.41 for Apple, and potentially for Google we are going to fall down a little bit further. I think Apple is the one which needs to fall in order to get us to the bottom, and then we'll be okay, we'll be able to turn around. Amazon is up 2.35% this morning. It's a very, very smart raise. It's up here. So its next resistance is going to be 122.46. I'm going to mark this red. I'm going to mark this again red and put it out there. And then let us go on to have a look at the commodities. Wheat is down 0.42% and copper is up 1.41, but it's in a consolidation stage down here. Last 2 days have been in the same range. Now let's go on to have a look at Genomics. I'll just sort this out so that we have the biggest loser on the top. Finally, ARK Invest has stopped buying Verve, and Verve has dropped 11.23% without that support. I'm thinking that Verve is likely to come and test the support of the 200-day simple moving average at 26.12. It's going to come down. And I have Bluebird down 8.9%, and it's up 2.13%. I think it's a dead cat bounce. SQZ Biotech no trades pre-market. Editas up 3.6% pre-market, and PICB up 3.34% pre-market. Illumina no trades pre-market. CRISPR Therapeutics up 3.01% pre-market. IDNA no trades. Teladoc up 2.16% pre-market. ARCG no trades pre-market. Invitate up 3.32% pre-market. Beam up 3.18% pre-market. Caribou Biosciences no trade pre-market. DNA up 3.93% pre-market. Intelia up 1.85% pre-market. IMTX no trades pre-market. Allogene no trades pre-market. So I think overall the genomics sector seems to be primed for a dead cat bounce, and once the dead cat bounce happens, maybe towards the afternoon or the evening, we are likely to come back down again. That's what I would like to say to you about today's market action. We are in very interesting times. As I say, these are the time for the record books and bragging rights. If you survive this, you would have a lot of bragging rights. This is one of the worst times in economics that we are seeing in the near past, and potentially in the near future, I hope. And with that, my friends, I'd like to bring this video to an end. I hope you have a good day at the markets. Please do not do anything hasty. Take heart that anything that goes down has to come up again. The market has always come up after going down. Recessions are followed by booms. Bust is also followed by booms. So things are going to get back better. Just hold on to your sense of self-worth, self-esteem, and self-belief. Don't do anything rash in the market. That's my advice. I'm also staying away from looking at my portfolio. Anything that happens is going to be chump change. Any dead cat bounce is not going to be worth it at this point of time. So I'm staying put. I'm staying put with my positions. Any new investment will come from fresh money that I can put into my portfolio. And friends, if you like this video, please press a like out there. It helps the channel. And if you're not yet subscribed, please subscribe and help us grow this channel. Thanks and have a great day. Bye for now.